For more on Powell's remarks, let's bring in Joe Lavorgna, chief economist at SMBC Nikko Securities America and the former NEC chief economist. Joe, great to have you. What was your take on Powell?
He didn't say anything new, which is good. I think that's why the equity market liked it. He didn't get more hawkish. And the reason for me he didn't do that, Melissa, is because the senior loan officer survey, which the Fed has and which they look at closely, tells us we're going into a recession because we saw massive tightening across the board: commercial real estate loans, C&I loans, consumer installment loans. And to me, that's what's conditioning his thought process. But he was dovish. I mean, he didn't push back against what the markets have been doing. And he didn't highlight the fact that he thought the employment report was really something that was going to be sustained.
What does that tell us in terms of what you see in that senior loan officer survey and the tightening that they are reporting and the lagged impact on the jobs market? We had a very hot number on Friday. When do we expect to start seeing that? I mean, if businesses aren't getting loans, they're not going to be expanding, they're not going to be hiring, et cetera.
Yeah, I mean, the data suggests that the recession literally could start any quarter. And I know the unemployment rate is low and the job number was great. I would argue the job numbers the last few cycles have tended to lag broader measures of economic activity such as GDP. But we have gone into a recession with the unemployment rate only up, a tenth or two from its low. So, a downturn this spring, Melissa, still very much is on track in my view. The yield curve is extraordinarily inverted. The market is telling you that the Fed is too tight. The senior loan officer survey confirms that. Powell is aware of it. Of course, he doesn't know what the outlook is. We're all making projections and doesn't want to become too dovish, too bullish on rates. But I do see long-term rates going lower.
Yeah, Joe, 80 basis points. Listen, we went from 81 basis points inverted down to below 50 basis points. We're back, I think. We got up to 80. It doesn't matter. We're at levels we haven't seen in 40 or so years. I think we're going to 1% inversion. What does that mean? Because I hear so many people saying it's different this time. What's different about it?
Well, nothing really. I mean, the thing is, if the curve is inverted, it basically means, guys, that your funding cost, your financing cost is more expensive than what you could lend at. And when that happens, credit tends to dry up, which is why the senior loan officer survey is so important. If the curve inverts more, that would suggest the possibility of a much deeper and prolonged recession if the Fed doesn't heed its message. Right now, as you know, the Fed is singularly focused on the labor market. To me, that's a mistake. I don't believe that too many jobs causes inflation, but that's the Fed's focus. So until that unemployment rate goes up, the Fed will continue, if not to hike rates, certainly keep rates elevated.
Joe, real quick, when you talk about breaking the back of inflation, or you talk about the potential that actually the Fed is pushing too hard on conditions, what's more important here to you as an economist for this economy, though? At least, wiping out the concept of inflation, and if the Fed has to move, too far, too fast, much in the way they were asleep at the switch, isn't that a good thing in the long run?
Well, they were asleep at the switch. Tim, the inflation expectations, 10-year break-even rate is down around 220. The five-year inflation swap, all the surveys of inflation expectations, they all tell us that inflation will moderate significantly. To me, the Fed should be now focused on growth, and it should be focused on where it thinks the economy is going. And to me, they compounded one mistake by, as you said, being asleep at the switch, with now another mistake, thinking they're going to keep rates on hold through most of 2024, which basically, Tim, would say this Fed's going to be on hold as long as it was following the 04-06 tightening cycle, which was very slow, very gradual. This one, as you know, has been very aggressive, and eventually the economy is going to really feel it. We're just not there yet.
Joe, just quickly, I'm wondering how, if at all, China reopening factors into your forecast of inflation here.
It does. To me, China is going to help on the good side because the things that are still in demand on, semiconductors are going to help autos and things of that sort. China is not going to have the same sort of expansionary growth in commercial and residential real estate. So their demand for commodities isn't going to be as high. So to me, I look at the China reopening as a supply-driven story that will actually help cause disinflation, not inflation.
Yep.
All right. Joe, thanks. Joe Lavorgna.
Thanks, everyone.
Great to see you. That's an interesting take on China.
Yeah. Listen, we talked about it a little bit last night. I mean, it sounds like the China trade and some of the inputs that we look at to measure it, it seems like it's cooling out a little bit. And again, to me, I think if a large part, and I think Tim kind of differs a little bit, of the enthusiasm about our market, our multinationals, has to do with the reflation trade with China. And I just think that a lot of the things that are going to go on with this Cold War, an economic Cold War that's getting hotter here, I think that they are inflationary. Deglobalization is inflationary. I think that if you think about natural resources and the way we're thinking about, all of this reshoring and everything like that, I just think that there's a lot of things that are on the horizon that could push us into a recession. And Joe seems to think it's happening sooner than later.